Stop chasing the green candle right now. Put your finger away from the buy button. We are sitting at $81,901, and we are pressing against the most dangerous price structure in trading, the double top. I am Eric from Alpha Market Meridian channel. Right here, right now, Bitcoin is staging a breakout, but the order book data and the correlation with the S&P 500 are screaming trap louder than they have all week. Most traders are looking at this green flicker and piling in, expecting a straight shot to 90,000. But the smart money is placing their orders exactly where we are about to reverse. There is one danger zone sitting at 82,400, and one hidden opportunity hiding at the 79,500 demand pool. I'm going to show you both, and if you stay until the end, I'm handing out the exact invalidation level and 3 precise trade blueprints you can use immediately. Do not miss the risk pulse at the 10-minute mark. It will save your capital. Here is your instant market verdict. The session bias on the daily chart is officially bullish, but the intraday 5-hour structure is flashing a fading signal with extreme caution. We are trading in a bullish macro trend, heading directly into a short-term range-bound compression. This is a low-volume breakout attempt, and low-volume breakouts are traps by definition. We are going to classify today as a fade-the-hype environment until we get a specific 5-hour candle close above the invalidation level. Write this number down and tattoo it on your screen. If Bitcoin closes a 5-hour candle above $83,763.09, the double top theory is completely dead, and I am wrong. Until then, assume gravity exists. The structure shifts entirely above that level. Below that, the bears are still controlling the range top. Look at the momentum. It's fading as price pushes higher. That is a recipe for a sharp rejection. If you want to be a profitable trader, you don't trade hope. You trade the reaction to the level, not the approach to it. Let's pull up the charts and walk through the architecture of this trap. We always start top-down, so let's zoom out to the weekly view. The weekly trend is undeniably bullish, painting a series of higher lows, and the 200-week moving average is sloping up gracefully way down at 44,000, acting as the bedrock of this secular bull run. But look closely at the weekly MACD. The histogram bars are contracting. Buyers are not done, but exhaustion is creeping into the longer time frame. We have a massive momentum divergence brewing, and that's the background noise. Now, drill down to the daily chart. This is where the fight is happening. Price is coiling right underneath the 82,400 resistance. This is the exact spot where the last rally got rejected violently. The moving averages are perfectly aligned for a bull trend. The 20-day average is crossing above the 60-day, but look at the 200-day average. It's sitting much lower, and price is heavily extended from it. The 200-day average is currently way down there, which means the gravity well is deep. If we break down, the mean reversion target is substantial. On the daily MACD, the signal line is flattening. We are losing the aggressive upward slope. Now, let's zoom into the 4-hour chart. This is the execution time frame. I want you to see the negative divergence here. Price has made a pushback toward the 82,400 double top, but the 4-hour MACD is making a lower high. This is classic hidden bearish divergence in a macro bull trend. It tells me the pullback isn't over, or this breakout is weak. The 20-period moving average on the 4H is sitting right at 81,100, curling slightly, providing dynamic support for now. The 60-period is down near the 79,800 zone, which is our major test area. If we drift lower, that 60 is the pivot. Finally, the 60-minute chart is our scalping precision tool. We are currently hugging the 20 and 60-period moving averages here, consolidating. Price is above the 200-period moving average on the 60-minute, which is positive, but the MACD has rolled over and is about to lose its bullish histogram entirely. The volume profile is thin. Between here and 82,400, there is a volume gap. Gaps fill fast in both directions. We don't have heavy support until we get to the daily support zone of 79,526. If that breaks, the next structural floor is 78,740. That is the line in the sand for the bulls. Here's what most retail traders miss. We cannot look at Bitcoin in a vacuum. While explaining these technicals, I'm watching the US dollar index and the S&P 500 futures. Bitcoin is the risk asset shadow right now. The S&P 500 is also struggling at its highs, showing a correlated exhaustion. If the S&P rolls over, Bitcoin's double top triggers instantly. They are moving tick for tick. This mutual validation is your early warning system. BTC funding rates are neutral right now, slightly leaning long, which means the fuel for a massive short squeeze isn't high, but the probability of a long squeeze is increasing if we just tick lower into the support. What changed in the last 24 hours to set this up? The narrative pivot is subtle but critical. We saw ETF flows flatline yesterday. 0, flat. The insatiable spot demand we saw pre-halving is digesting. The headline screaming Bitcoin faces double top near 82400 resistance isn't just noise. It reflects a structural hesitation. Institutions are not buying this breakout yet. They are waiting for confirmation or a deeper discount. Yesterday's risk asset movement in the Nasdaq futures showed a reversal off all-time highs. Bitcoin is the high beta play on that liquidity tide. When the Nasdaq futures fail, Bitcoin historically crashes through local support. This cross-linkage is the most important thing to watch. Connect the narrative web here. We are seeing a divergence between gold and Bitcoin. Gold, the fear architect, is holding steady on geopolitical bid and real yield expectations, while Bitcoin is chopping. If we were in a pure risk-on euphoria, both would be flying. The hesitation in oil prices on supply shock fears is introducing a cost-push inflation narrative that scares growth stocks, which in turn scares Bitcoin. So, the risk-asset correlation is tightening. If the S&P 500 breaks its 5-day consolidation downward, Bitcoin will not hold 78,000. It just won't. My 1 to 2 week directional lean is a corrective move. I believe we retest the support floor to gather liquidity before a credible push through 85,000. I have a bearish bias for the next 10 trading days, purely because the rally looks tired and the double top is a respected pattern that requires a liquidity grab below to fuel the next leg. The exact event that invalidates my bearish thesis is a high-volume daily close above 83,764. If that happens, the double top fails, we flip to a breakout chase, and target 85,000 immediately. Until then, I'm fading strength. Most people will click away now because the technical overview is done. They will skip the actual blueprint section. But this is precisely where money is made. Keep watching because I'm giving you the exact triggers, not just theory. This is for the patient trader who wants the highest probability of a filled order with structural confirmation. The trigger condition is a false breakout or a clean retest of support. Price is trying to break 82,400. A false breakout happens when we spike above 82,400, trap the breakout buyers, and reverse back inside the range on the 5-hour close. We snipe the breakdown. Alternatively, if we don't get the false breakout and just drift down, we wait for the test of the daily support at 79,526. The exact entry is a limit order at $79,530, resting right on the support. The stop loss goes at $78,700, just below the structural low, giving us a tight logical invalidation. The stop logic is simple. If the 78,700 floor breaks, the macro structure is damaged. Target 1 is 82,300, a move back to the range high. That gives you a risk-reward ratio of roughly 1 to 4. Target 2 is 85,000, for a 1 to 8 risk-reward. What voids the setup? A high volume close below the stop loss. If it slices through with volume, don't try to catch the falling knife. Strategy 2, the active trader, standard. This engages the bounce off the dynamic. Moving average support. The entry condition is a mean reversion play. On the 4-hour chart, the 60-period moving average is currently sitting near 79,800, curling up. If price pulls back and touches this moving average and prints a bullish engulfing candle on the 1-hour chart, you enter long at 80,100. The stop-loss placement reasoning here is mathematical. Put your stop below the recent swing low and below the key support, so stop goes at $79,300. You're risking $800. Once target 1 at $82,400 is hit, you take 50% profit and move your stop loss to entry. This makes it a risk-free trade. Target 2 is $83,600. If momentum is strong, use a trailing stop of 1,000 points once past $82,400. I want to pause here for an interaction mine. Let's see how aligned our community is. Type your Bitcoin price range for tomorrow in the comments right now. High and low. Are you seeing 85,000 or 78,000? I'm reading them, and I will pin the most accurate projection. Strategy 3, the Aggressor, high risk. This is a countertrend or momentum chase entry. I call this the trap slayer setup. We are not waiting for the false breakout. We are shorting directly into the double top resistance with a tight stop, betting on the rejection. The trigger is a limit short order at $82,200. Your stop loss must be unbelievably tight. Place it at $83,100. The logic is if price pushes past the range of $83,700, we are wrong, so a stop just below the midpoint is insurance. The target on the downside is the $79,500 support for a quick scalp. Target 1 is $80,000. Target 2 is $79,800. This is a counter-trend scalp against the daily bull trend, so your size must be small. Only for those who know how to lose small and manage risk aggressively. If price breaks $82,400 with a massive volume spike, cut it manually. Don't wait for the stop. This setup tries to catch the liquidity grab that triggers the sniper's long entry time for the non-negotiable risk pulse. Do not ignore this. Never risk more than 1 to 2% of your portfolio on any single Bitcoin trade, especially on an aggressive short against the trend. No positions through high-impact news or sudden S&P 500 gap openings. Stops are non-negotiable. If your stop at 78,700 breaks on a candle close, you cash out. You don't hope. You wait for the re-entry. Capital preservation is the game.so. We breathe out. The critical level for the next session is unchanged, 82,400 resistance. The entire market structure hinges on a rejection or an acceptance there. Tomorrow, I'm focusing intensely on the S&P 500 divergence because that liquidity tide is turning, and it's going to dictate whether Bitcoin has a chance. If the S&P cracks, the Bitcoin trapdoor opens wide. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Click the end screen right now to understand why the stock market correlation is screaming danger. You need to see the liquidity depth on the DXY video I dropped this morning too. It all connects. Smash the like button if this analysis gave you a clear plan and saved you from buying the top of a trap. Subscribe and hit the notification bell. We do this every single day across 8 assets. I comb through the oil supply shocks, the euro fracture, and the gold fear prints so you don't have to. I'll see you in the next one. Stay sharp.